Most people think investing has to be complicated. They picture stock pickers, market predictions, and people refreshing charts all day trying to outsmart Wall Street. But for most people, the smarter move is a lot simpler than that. It's called an index fund. And if you understand this one idea, you're already ahead of a lot of people who have already been investing for years without really understanding what they own. In this video, I'm going to explain to you index funds in a way that actually makes sense. So what is an index fund? An index fund is an investment that tries to match the performance of a market index. That sounds really technical, but the idea is simple. Instead of trying to pick one winning company, an index fund gives you a slice of a whole group of companies at once. For example, some index funds track a big group of US companies. Others track the total stock market. Some track international companies and bonds too, etc. So instead of betting on one stock, you're spreading your money evenly across many businesses at the same time. That's the big idea. Now, why do people like index funds so much? Well, because they're simple. They're usually way cheaper than actively managed funds with lower fees, and they usually perform way better than actively managed funds. You see, you're not trying to predict the next big thing. You're not checking every headline. You're not asking, should I sell this because the market had a bad week? You're just buying the entire market and letting time do the work. That's the part most people underestimate. A good investing system is not about excitement. It's just about being consistent. A lot of beginners start by thinking investing means picking individual stocks. And that's a great way to make investing feel fun, but it's also a great way to add a lot of stress and to lose a lot of money. Just head on over to Wall Street Bets on Reddit and you'll see what I'm talking about. You buy one stock, you're betting on one company. When you buy an index fund, you're betting on a whole basket of companies at once. So your odds of doing well are much higher. Now, that's not to say that index funds always go up. They don't, but they do give you diversification, which is one of the main things you want as a long-term investor. In plain English, it just means if one company does bad, the whole portfolio doesn't depend on it. This is especially good too if you're using something like a Roth IRA, and those investments have to do well so that you can survive retirement. Otherwise, you're just basically YOLOing. You're basically just YOLOing your life if you don't know what you're doing. Now, you'll hear a few different words here where people talk about ETFs versus mutual funds versus index funds, etc. This is where people get lost, so I'm going to try and make it simple. An index fund can come in the form of a mutual fund or ETF. The structure is different, but the main idea is the same. You're tracking a market index rather than trying to beat it. For a beginner that's just getting into personal finance, this part is completely not worth obsessing over. The important part is whether the fund is a low cost, diversified, and easy for you to stick with index fund. That's actually what matters. So I'll try to pick a real example so that you can follow along to kind of understand what I'm saying in the simplest way possible. So first, what is FXAIX? It sounds crazy, but it's Fidelity's 500 index fund. It's basically designed to track the S&P 500, which means it gives you exposure to the 500 largest companies in the United States. Again, it means you're not betting on just one company, you're buying a broad slice of the market. Also, FXAIX is popular because it's a low-cost, easy-to-use index fund that's designed for long-term investing, which is what I personally use myself in my Roth IRA. The Roth IRA gives you a tax advantage, and the index fund gives you the growth potential. So the combination is very powerful. A Roth IRA gives you tax-free growth on your money, and FXAIX gives you exposure to the S&P 500 with very low fees. AKA, you're investing in the entire US stock market through the top 500 companies, and that gives you an average return of about 10%. Again, that's about average minus inflation and all that fancy stuff. And again, trying to keep all the jargon away and make it kind of simple for you to understand. Doing something like this obviously makes you way more money than keeping all your money locked up in a high yield savings account, and especially stuffing it under your mattress like I used to do personally. I had no idea about anything about personal finance until one day I realized that, yeah, I was keeping money under my mattress, which was actually losing money due to inflation. Because if you look it up, inflation kind of goes on an average of 3% every year. So think about it. The money in your bank account actually loses value at 3% interest every year. Negative. That's not really something you think about when you're just starting to get into it. Most people think, oh, I need to work really hard and make a lot of money, and then I could feel safe. But the safest thing you could do is actually invest your money, because by not investing, you're actually losing money. It's really crazy to wrap your head around, but after you watch this video, I definitely recommend to look up, some more videos and do some more research, but it's really crazy how that works. So I'm going to talk a little bit more about the Roth IRA, because if you invested the same money in a regular taxable account, you can end up paying taxes along the way. And that's just not something you want to do if you have millions of dollars inside, or even hundreds of thousands of dollars inside. So when people personally ask me, what's a simple investment setup? I just say, open a Roth IRA and buy FXAIX. FXAIX. Or you can buy VOO, which is essentially the same thing. They're technically very different, but they're essentially the same thing, VOO and FXAIX. And index funds are very useful because they remove a lot of guesswork. All you have to do is focus about putting money in, which I love. I think it's great because all you have to do is make extra money and put that in there and it goes to work for you. You don't want to spend your whole day figuring out what stock is going to blow up or do good or whatever, or it's going to go bad and you're going to have a heart attack. I mean, you literally just have to focus on making extra money and putting it in there and letting it work for you. A lot of people love to talk about a lot of these kind of like Airbnb things like, oh, I have this property that I rent out and it makes me money in the background when I sleep. It's passive income. But in reality, there's not really anything kind of like passive income besides investing. Investing is the only way that you can really have passive income. Completely passive. Like literally I'm sleeping and my account is just growing while I'm sleeping. You can't really do that with rental properties or, you know, real estate investments. Like you kind of sort of can, but you have to keep up with it and stuff like that. And this is just essentially one of the best ways to get wealthy by literally just doing nothing. You just put your money in and let it grow. But it does take some time. That's the only con about it. Now, the next part I want to get into about this video is about people overcomplicating things and analysis paralysis, which I used to have. And I find a lot of people used to waste months arguing over tiny little differences when they should get started with a good low cost index fund. Oh, should I choose FXAIX? Should I choose VOO? Whatever, SCHD. The point is just get started. Just pick one of them. They all perform relatively the same. Now you could go ahead and Google and do some quick research, whatever. You can also sell the funds and change what you're invested in later. You're not locked in. You can always change your decision at a later time. If you pick Fidelity and you don't like them, you can move on to, let's say, Vanguard. If you don't like Vanguard, you can move over to Schwab. You're not stuck with any of these brokerages and you're not stuck with any of these funds. You can move your investments around. You can move your brokerages around. The biggest point is to just get started. It took me personally a long time to try and figure out where I was going to go. And I just picked Fidelity because they're the most popular and they have a great credit card that I like. And they have the best customer service. So I ended up going with them. But if you don't like them, just go with someone else. It doesn't really matter as long as you just get started. Don't wait for the time to be perfect. There's never a perfect time to start investing. You just start as soon as you can. As soon as you have your birthday and someone gave you $20, invest half of it. Just do $10. Let time work for you and that's it. Log in and check for fun that you see your $20 grew to $1 after 2 weeks. And that's it. That's how you get started. If you found this video helpful and you want to see more videos like this, make sure you like and subscribe. Thanks for watching.